Welcome. My name's Esther Carter. I'm going to be doing some light chairing of this morning's webinar, which is part of our enterprise series, and we're going to be covering the post-budget inheritance tax landscape. As usual, there's quite a few familiar faces on the delegate list today, our loyal followers of these enterprise webinars. And so a lot of you probably are familiar with who we are, but for those of you who aren't, Moore Kingston Smith is a top 10 audit, tax and advisory firm. We work with entrepreneurial businesses across all different sectors, as well as not-for-profit and private client. We're also part of More Global, which is an international network with presence in over 100 countries, so also very well placed to support your international needs as well. So Labour's first budget brought significant changes to the inheritance tax regime, and that really will have a wide-ranging impact for many families. And while estate planning can be quite a daunting process, it's really important to understand how the latest announcements will affect your estate and what planning you can do to minimise the inheritance tax payable and maximise the wealth passed on to your loved ones. So in this webinar, our panel of experts will break down the key policy changes, talk about their implications and explore how best to navigate these changes. So I'm delighted to be joined by David Painter. David heads our financial planning team at Moore Kingston Smith Financial Advisors. And as well as managing the team's overall strategic direction, he remains very much a hands-on advisor, looking after private individuals, business owners and trustees, and covers all aspects of financial planning, including wealth management, retirement and intergenerational planning. Also delighted to welcome Claire Roberts, who is a partner in our private client tax team, and she advises on all aspects of personal tax, with particular expertise in inheritance tax, trusts and succession planning. And as a firm, we really are uniquely placed to offer a joined-up approach to estate and succession planning to ensure that the tax and financial planning aspects of every scenario are covered. So a little bit of housekeeping before we start. This webinar is being recorded, so please do share it with your peers or anyone who was unable to make it this morning. This webinar is for you. You'll get the most out of it if you're able to ask some questions throughout. So please do put questions to us. Please put them in the Q&A function, and then I'll attempt to weave those in throughout the questions as we go along, and any unanswered questions will be dealt with at the end. There will be a feedback survey at the end as well. Be super grateful if you could complete that, as it really does help us to shape our future webinars. So starting with you, Claire, really, could you just sort of give us a bit of a summary about the changes that were announced to the inheritance tax regime in the budget?
Sure. Thank you, Esther, and good morning, everyone. So just to set the scene, really, in terms of the budget, I mean, the Chancellor announced £40 billion worth of tax increases. So tax as a share of national income is higher than it's ever been, but just 6% of that came from inheritance tax, and yet this has dominated the press in recent weeks. So there were two main changes to inheritance tax, but if we just focus for now on the big change that will affect business owners, farmers, and that was the restriction to agricultural property relief and business relief. So agricultural property relief applies to land and property used for agricultural purposes, so farmland, farmhouses, and business relief applies to business assets, provided those businesses are not investment businesses. And currently, as it stands, those reliefs provide 100% relief from inheritance tax, and it's uncapped. So what the government is now proposing is that from April 2026, 100% relief will only apply up to a combined limit of £1 million per individual, and that any value in excess of that 1 million allowance will qualify for relief at a lower rate of 50%, which effectively means above that 1 million allowance, you're paying 20%. Effectively inheritance tax. An important point to note here is that unlike the nil rate bans, which you can transfer to your surviving spouse or civil partner on the first death, that this allowance isn't transferable. So a key point here will be looking at wills and making sure that they are drafted correctly to make the best use of this 1 million allowance. That allowance will cover property in the death estate, transfers to individuals in the 7 years before death, and lifetime transfers into trust. And there will be a consultation early next year looking at the application of that allowance, particularly with regards to how it will apply to trusts. One thing that the allowance won't apply to is shares listed on a recognised stock exchange. So there we're talking around AIM shares. And instead, what was announced from April 2026 is that the rate of relief applying to those shares will be reduced to 50% full stop, regardless of their value. So what does this mean? So each individual has a nil rate band of 325,000, and if your estate is worth less than 2 million, then you also have a residence nil rate band of 175,000. If you have a home in your estate that you leave to your direct descendants. So potentially you can pass on up to £500,000 tax-free, or if you're a married couple, potentially £1 million. So on top of that, you've then got this 1 million allowance if you hold business qualifying assets that qualify for business relief or agricultural property relief. And why these changes? So, I mean, in their words, the government claim it's just simply not fair that a small number of claimants each year benefit from such a significant amount of relief, and they claim that the majority of estates won't be affected. They've estimated that 2,000 estates per year will be affected by the changes, of which 500 will claim agricultural property relief. But if you've been following the press recently, you'll know that the farming bodies, the unions are saying actually this number is far higher. So there is still a bit of uncertainty around, the actual impact of these changes. And clearly the obvious concern here will be, well, how are we going to pay the tax? Where are we going to find the cash without selling or breaking up the business or the farm? There will be the ability to pay the tax in 10 equal instalments over 10 years, which should be interest-free. So that should help sort of relieve the liquidity issues somewhat. But for some businesses and farms, that's, if they can't extract cash from the business, then that's just not really going to help.
Yeah, quite big changes and lots of very unhappy people. So what planning opportunities are available for family businesses that are affected by these changes?
Yeah, good morning. I think there's a number of opportunities, and it's not just going to be family businesses. It'll be anyone that's got a shareholding in a company. As Claire mentioned, this isn't going to take effect until April 2026. We've got final consultations. We think there is going to be some devil in the details. So I think the important thing to know, anyone on the webinar, don't go off and make sort of rash decisions on the back of this, but you need to think about your planning. So for business owners, now whether that's a farm or another type of company, I think there's some general housekeeping that you can have a look at. So the first thing is to go and have a look at the shareholder agreement or the partnership agreement that is there. That should stipulate what happens to the shares or the share of the partnership on death. Now, a lot of farms are actually based on a partnership, and quite possibly it's there's no formal partnership agreement in place. And if that was the case, then technically under the 1890s Partnership Act, that partnership would be dissolved on the death of a partner. So the first thing, go and have a look at the partnership agreements. Make sure there's a clear plan of what happens to that share on the death. The second thing to consider is, how are those shares held? If it is a family business, are all of the shareholding are they just in the husband's name, or are they just in the wife's name? Because as Claire mentioned, we don't think this allowance is going to be transferable. Therefore, equalising the ownership of the company to make sure that both spouses can benefit from this allowance is really important. Claire's also mentioned about making sure the wills are appropriately written. Pre the budget, we didn't have to worry about any limit on business relief. So actually, a lot of wills will say everything goes to my spouse, and then it passes on after that. I think what will happen, we'll see an increase in the use of will trusts, so that actually any exempt assets on the first death might go into a trust. Surviving spouse has access to that if they need them, but actually it's outside of their estate for the second death. Claire mentioned about funding some of the tax. One of the planning points that we've used for for many years is really basic life assurance. And I think for a lot of business owners or indeed farmers, if they don't have liquidity, it's going to cause a problem. It's going to force them to sell assets in order to pay a tax bill. The alternative, as I say, is to take out very basic life assurance, which is written in trust. It goes on to the executors, and that covers the cost of that tax bill. So there's some of the basic planning points for business owners.
Thanks, David. Claire, what about from your perspective?
So I guess let's focus on perhaps more of some of the positives that came out of the budget. So there were no changes announced to the tax treatment of lifetime transfers. So if you make a gift to an individual, provided you survive for 7 years from making that gift, that value falls outside of your estate for inheritance tax. So what we may now see is that business owners will likely need to consider lifetime giving as a sort of planning strategy, perhaps earlier than they would have done otherwise. And it may also be advantageous to consider transferring relievable property into a trust, which until April 2026 will benefit from unlimited relief going into the trust. And the same 7-year rule applies there, that if you survive for 7 years, then that value is outside of your estate and ring-fenced within the trust. With the benefit of the trust route being that, as a trustee, you could retain some control over how the trust assets are used. So there is that window of opportunity there for, transfers into trust before April 2026. But a few health warnings really with lifetime giving. There is the government announced an anti-forestalling measure that means that for any deaths after April 2026, where you are making gifts now, after the budget, those gifts will be called by the new rules. So if you don't survive for 7 years, the new rules will apply rather than the rules in place at the date of the gift. Another thing to think about with lifetime giving, that the gifts, they have to be absolute. So no strings attached. You can't retain any benefit from that gift. Otherwise, that value still is within your estate for inheritance tax. So clearly, that might not be an option for some people. They need to possibly retain the income from the asset being given away. So that's another consideration there. And clearly, with any sort of lifetime transfers, you have to think about other tax charges that could be crystallised, capital gains tax being the main one. And it might be that holdover relief is available to protect that capital gains tax position, but that would only merely defer the gains until some point in the future when the asset's sold. And I think just a really important point to mention here in terms of lifetime giving is that if you give that away, then you lose the benefit of the capital gains tax uplift to market value on death. So if the value of the asset you're holding, let's take shares, for example, in a company where that value is potentially all capital gain, you'll have to weigh up whether the benefit of giving it away, retaining that IHT benefit, whether that outweighs the potential capital gains tax. Whether it outweighs rather the loss of the capital gains tax uplift on death. And that will be very much a case of sort of crunching the numbers and then looking at the estate position.
A bit of crystal ball gazing there, really, because you don't necessarily know the value or the increase in value that there might be in that period.
Well, indeed, yeah.
So if you had, so somebody's asked if you were wanting to give away your farm business, but there was a residential property on that farm, could you give it away and still live in the house but not farm the land?
Potentially with some planning. It's quite difficult to plan with the family home for the reasons I mentioned in terms of the gift with reservation of benefit. There are ways that you can avoid it by potentially paying a market rent for your occupation, which can be quite an expensive route because you'd have to pay income tax on that rent. There are things you can do, but it's tricky to give away the family home and continue to live in it.
What about existing trusts that people have already got? What do the changes mean for those?
So the changes will apply equally to trustees. That combined 1 million allowance will apply to trusts, both on the 10-year anniversary charge and on any exit charges. So what that means, if you're familiar with trusts, is every 10 years there's a tax charge on the value of the trust assets up to a maximum rate of 6%. So effectively that will now be a 3% rate, which may be more appealing than 20% on death, if 3% every 10 years. That 1 million allowance will be divided between trusts if you set up more than one trust, unless you're setting up trusts now, in which case that 1 million allowance will be split between them. And that's essentially to prevent individuals setting up trusts now with a view to obtaining multiple 1 million allowances. So for trusts now, the important thing will be review the position, particularly where you have a trust that hasn't historically paid any tax, but potentially because they've held shares in the family business. Because now the options for funding the inheritance tax may be more limited, and the only option may be, for example, to declare a dividend from the company to pay the tax, which will incur income tax, so could be quite expensive. So existing trusts will need to be reviewed.
Thanks, Claire. And what about, obviously it wasn't just about agricultural property, was it? There are big changes coming into unused pension funds that are announced in the budget. What are the key changes there?
Yeah, so big changes there, and arguably a change that will affect most of us. So as it stands currently, uncrystallised pension pots are generally exempt from inheritance tax. And in recent years, for that reason, they've been used as a way to pass on wealth to the next generation. And to remove that incentive to use pensions for that purpose, the government announced that unused pension pots and death benefits payable from a pension pot will be brought within the scope of inheritance tax from April 2027. And as part of these changes, pension scheme administrators will be responsible for reporting and paying that tax, which many have commented will be a bit of a nightmare administratively. So one of the big things here is that there's been nothing published to suggest that the income tax treatment for beneficiaries inheriting pension pots will change. So what it will mean currently if you inherit a pension pot from someone that's died over the age of 75, you will pay income tax at your marginal rate on any withdrawals. So from April 2027, over the age of 75, if you're inheriting that pot, then you could be subject to both inheritance tax and income tax. And if you're a higher rate taxpayer, then that effective tax rate could be 64% before you've even received anything, which is clearly quite high. And in some cases, it could be as high as 90%. And that's where the inclusion of the pension pot could cause the estate to breach the 2 million threshold at which that residence nil rate ban that I mentioned earlier would begin to taper away. So some people have commented saying, well, hold on, shouldn't the IHT be based on the net of tax amount after income tax, which, well, we may see the government reconsider that position, because again, there's a consultation open regarding the implementation of those charges, and no doubt that this potential double whammy of tax is something that will be raised.
Thanks, Claire. So, David, what sort of planning can we be considering to sort of try and counteract the changes around the pension pots?
Absolutely. So first thing to know, obviously the effective date of this is April 2027. So again, no rash decisions, but you need to start thinking about the planning now. As a financial planner, since 2006, when the government introduced the aptly named pension simplification, I can't think of anything more complicated over the last almost 20 years. In 2015, George Osborne then announced that pensions were going to be taken out of the IHT net. And as a planner, we had a look at clients and their assets, how much income they needed, and we typically left the pension pot until the very end. It was an asset that they had access to, but if they didn't need it, it went through the generations nice and efficiently. So that's changing. So the first thing that I think people need to consider is have a look at your income strategy. How much income do you need, and where are you going to take it from? Because, after April 2027, it's probably going to be more beneficial to use your pension pot to generate some or all of your income requirement. And if there's any other exempt assets, then actually leave those until last. Something else to consider that, Claire mentioned the pre and post age 75. That's a really important age. And at the moment, that still seems to be the case. So if somebody dies before the age of 75, then a recipient of their pension pot can actually withdraw either income or lump sums free of any income tax. Now, where the pension pot is being left to a spouse, the spousal exemption is still going to apply. So pre-age 75, keeping your money inside the pension pot still seems to be the most efficient way. Post age 75, or as you approach age 75, certainly some of the planning should be actually take that amount, the tax-free amount out, and then you can do other planning with that. That could be putting it into a trust, it could be gifting it away, it could be using that to potentially buy business relief assets. One of the questions we have asked a number of providers is it going to be possible to use your pension fund to buy business relief qualifying investments? The issue there is going to be whether the pension providers will allow that sort of asset to be in there. But I think watch this space, that could be an option. So I think as far as the pensions are concerned, pre-age 75, keeping it in that wrapper is very efficient. At age 75, making sure the lump sum comes out. Post-age 75 is using your pension to fund your income. Now, we've run a few of the numbers, and if you, let's assume that you had an expenditure of £50,000 a year. Well, actually, if you took out £100,000 a year from your pension pot, the effective rate of tax is £27,500. Claire mentioned earlier about the ability to make regular lifetime gifts out of regular income. And on the basis that we can, or you can evidence and demonstrate that that hasn't negatively impacted on your standard of living. And that's done by keeping quite careful records about what was your income, what was your expenditure, and what was your gift. Then it is possible to pass money via a regular gift to a non-spouse, which is immediately outside of your estate. So that lifetime giving, we think, will actually increase in popularity post-April 27.
And someone's asked, are there limits on the amounts that you can gift via lifetime giving?
No, there's as long as you can evidence that your income net of any tax exceeds your expenditure, then any surplus can be gifted away. But the important thing is you have to keep quite detailed records. In financial planning, we do this all the time. And if you've got a financial planner, when we ask about trying to break down your expenditure, I know it's frustrating, but there's a bit of method behind that madness. And if you want to have a look on, I think it's page 8 of IHT 403 form. That's the form that your executors have to fill out when they're looking at gifts out of regular income. So you can see exactly the sort of details that you need to keep. We do this for an awful lot of clients, and it can save hundreds and hundreds of thousands of pounds over the lifetime of a sort of planning on those gifts.
Thank you very much. So there's a few questions come in. Somebody said, could you explain if there's a difference between defined benefit and defined contribution pension schemes? And what about money held in SIPs as well?
Yes. Okay. So a defined benefit scheme is a promise to pay an income, and a defined contribution scheme is essentially a pot of money. So they're two very different things. They both got the word pension in it, but they're treated very differently. So with a defined benefit scheme, if you are a pensioner receiving that income, typically there will be a spouse's pension. So on your death, your income would continue to your spouse, in most instances at a slightly reduced rate. And if it's going to a spouse, then there's that spousal exemption. That's not an issue. That income continues. There is some thought, and again, that the devil's going to be in the detail of the rules, that where there is a dependent pension that is going to a non-spouse, that may well be capitalized and included in the calculation of inheritance tax. Now, as I say, that these rules are still in proposals. The devil's going to be in the detail, but we think that there will be certain types of pension income for dependents that might be caught up in this, and also potentially pension lump sums. So if you're an active member in a defined benefit scheme, so you haven't yet retired, on death there is normally some form of lump sum, and some defined benefit schemes that will be taken into consideration when calculating inheritance tax. What the rules have said is that where there is a death in service scheme that is running alongside a pension scheme, that is out of scope. So at the moment, those rules say that death in service will not be added to your estate for inheritance tax purposes. Defined contribution schemes are just a pot of money. So that pot of money will be included in calculations.
Thanks, David. And somebody's asked, does it affect the tax rate under the new rules after April 2027 if the pension is inside or outside the old lifetime allowance?
No, so the lifetime allowance has been essentially abolished. The previous government introduced something called the lump sum death benefit allowance. Again, it still isn't clear how that is going to link up with these new rules coming in April 27, and I think that will be part of the consultation and some of the details that's going to come out over the next 2.5 years.
Just going back to, I think a few previous questions ago, a question came in, it's a bit late for me to squeeze it in, but somebody said basically, is the simplest and most effective way just to have life insurance and then name the beneficiary as the person that's going to be paying the tax bill, for example, your children?
Absolutely. I think in the past, a lot of people have used life assurance. And I was actually doing a presentation yesterday to the partners, and one of the things I said is we don't go out and buy life assurance. It's something that has to be sold and recommended. And whether there's a stigma around life assurance, but definitely as far as inheritance tax planning, and indeed making sure that your business can continue in the event of the death of a shareholder, life assurance is by far the cheapest and the most flexible way to cover the tax bill. It doesn't mean that the tax isn't going to be paid, but it does mean that the assets that you've worked so hard for your entire life all pass down to the children. So yeah, life assurance should be looked at.
And you did some quite interesting slides, didn't you, that showed you'd have to live to quite a ripe old age for it to become ineffective.
Yeah, absolutely. I mean, it's really difficult to throw lots of numbers out without a slide, but just to give you an example, for a 65-year-old who wanted to take out some whole of life assurance, so that's a plan that will continue, as the name suggests, for the whole of your life on the basis that premiums are paid. We did a quote on £500,000 worth of cover. That cost was £970 a month for a 65-year-old in good health, non-smoker. Now, that 65-year-old would have to live to the ripe old age of 136 before the net benefit, versus the cost was being outweighed. So it's very, very flexible. It's very, very good value. But when we're doing inheritance tax planning using whole of life, we always do that in conjunction with the beneficiaries. The reason being, so we're doing that across 2 generations. The reason being is that, heaven forbid, in later life, should a power of attorney need to take over financial control, sometimes they say a big number going out of your bank account every month, and it's just cancelled. And that means that cover will lapse. And that's how the insurance companies actually make the money out of this type of policy. It's the number of people that cancel the life assurance before anything's happened. So yes, it's good value, and come and talk to us and we can do some numbers for you.
Thanks, David. Somebody's asked, if you had fixed protection 2014, can you still take out the higher lump sum tax-free amount?
Yes. So with again, this goes back to the whole pension simplification from 2006. It's ever so easy. There are many forms of transitional protection that when the lump sum allowance was written into legislation as £268,250, if you had previous protection, then you're still entitled to take that higher level of lump sum. So yeah, fixed protection, whether it's 12, 14, 16, is all still valid. If you've got enhanced protection or primary protection, which is the protections valid from 2006, there is still the ability to maximize your lump sum.
And one of the questions actually we had in advance was around, will the new rules apply if the person is already deceased, but probate and tax are not yet settled?
No, is the answer. It's for deaths after April 2026.
Lovely, thank you. So finally, what action should people be taking now?
Yeah, I've said it throughout really, which is, don't take any hasty action. Actually, you need to start reviewing. Some of the rules are coming in April 2026. That's 18 months. Some of the rules April 27. So don't leave it until March 26 or March 27 to have a look at the planning. Start doing the planning now, and then consider all of your options. I've said before that at the moment these are proposals. It's got to go through legislation. There are likely to be some tweaks. If there's enough shouting, there could be some significant changes. We just don't know. But think about the planning. And also, if you're doing inheritance tax planning, I'd always encourage you, include your children or the beneficiaries in that planning so they know what's happening as well.
Yeah, I mean, I would just echo those comments really. They could be subject to change. We could see the government backtrack on a couple of things. We don't yet know. So I think, priority at the moment would be, establish what your potential exposure is, post April 2026. If there is a liability, think about how you could fund that. Is there sufficient liquidity? And just start thinking about a plan. I think reviewing your wills is a priority, particularly to look at whether that 1 million allowance, is both spouses will benefit from that. And finally, there's no one size fits all answer here. So personal advice will be needed, and it will very much depend on your circumstances. So please do talk to us.
Yeah, I mean, on the wills point, I mean, I find it staggering the number of people I speak to who've got a sensible size of wealth that's worth planning for, that don't have a will because they don't really want to start having those conversations because it's a bit upsetting and it's emotional. But I mean, it's just becoming so much more important now, isn't it, to make sure you've got one in place. I've got a few, another question coming. If you're gifting a furnished holiday let before April 2025, is it considered part of your estate if you die before 7 years elapses?
Yes. So, I mean, the 7-year rule still applies. So if you were to die within that 7 years, that value, the value of the gift will be within your estate. But if you survived between 3 and 7 years, then the inheritance tax, any inheritance tax payable, would be reduced by taper relief. So potentially it is the answer there. The fact that it's a furnished holiday let is irrelevant really there.
Bit of crystal ball gazing as to how long one's going to last to get the 7 years right.
Just adding on a point there that if you are doing larger gifts, then actually you can take out gift into vivus life assurance, which is specifically designed for that 7 years, and it tapers down towards the end. So a couple of the points and questions earlier about is life assurance the easiest and most flexible? Actually, yes, it is in that scenario.
And finally, obviously you don't know the answer to this, but just your thought. I mean, how likely or not do you think it is that the government is going to row back from some of these new bits of legislation they've put in, given the backlash that they've had?
Who knows? At the moment, they seem to be sticking to their guns and saying, no, the majority of estates are not affected by these changes. And I think they're going to have to address the fact at some point that the figures they're producing, the figures that everyone else is producing are wildly different. So I think they're going to have to come to the table at some point and say, okay, well, this is how we got to this figure. Whether they will backtrack, increase the cap potentially, it's yet to be seen. Who knows?
Yeah, I think regardless of whether the what the final rules are, probably a good point in time for everyone to have a look and reevaluate the planning, make sure it is up to date, and make sure it's flexible enough if it is to change again in the future.
And I suppose that's why people should really be jumping into doing anything too quickly or making any rash decisions, just in case there is any tweaking of the legislation that they've brought in.
Exactly right.
Super. Well, we have come to an early end. I've given you all 8 minutes back in your diary, which I'm sure you'll all be very grateful for. So thank you, David. Thank you, Claire.
Thank you.
Lots to think about there. And I think lots for the audience to think about in terms of the planning that now needs to happen over the next few months to make sure they maximise their inheritance tax position. So thank you all very much for listening today. Please do fill out the feedback form. Like I said, it's super useful in helping us to shape future webinars and timings, etc. And it was being recorded, so do share it with anyone who wasn't able to make it. Thank you very much and enjoy the rest of your day. Thank you.
Thank you.
Bye.